Hi, as hopefully some of you got to introduce, my name is Jed Collins. I am the founder and creator of Money Vehicle, where we are trying to change a student's perspective of money. This session today, we're going to walk through why do we need to start investing, how to begin investing, what vehicle should I use in investing, and really adapt this message of overwhelming fear of investing to, well, this is a practical action and practical step. I will hand these out, and I will probably forget these sign-up sheets, but that's okay. There is old school and new school, so there's a QR code. If you'd like the QR code, there is a sign-up sheet. I'll put this one over here. To meet, to discuss, by all means, hand those around if you can. If you would like more information on what we're about to discuss and walk through, that is how you can get a hold of us and a hold of me. I was so gracious to get the opportunity to use some of these posters already up on the wall. And so I want to begin with why. Why must we begin to invest? I would like you, if you're taking notes or just a quick thought experiment, somebody walks by you and says, "Thank you, great job. Here is $100. What is the first thing you would go spend that $100 on? You don't need to answer. Just think in your head, $100. What am I going to go do with the $100? Anybody have a quick, easy one? Plants. I'm going to go get some new spring plants. Hopefully your flowers are starting to blossom and bloom. That's an excellent one. $100 plants. It'd fill that up. I love it. So as we look at it, quick introduction to how we think. Second question, $100, I went and I bought something. Now, if that money changes to $1,000, somebody gives me $1,000, do I start to think through it differently? Is there something that I've been saving up for? Maybe it's, God forbid, a pair of shoes, but a vacation, a car, a gift. I have now $1,000. Now I'm starting to think about it differently. And then my third question would be, that number changes to $10,000. Somebody hands you $10,000. Where does your mind go? What do you start to think about and how you are going to use those dollars? This quick thought experiment introduces us to our three types of oars. We have our spend oars, our save oars, and our invest oars. Do all three of these actually end in OR? No, but we're talking about money, not English. Type of oar is a much easier frame and idea and concept to start to understand, start to learn. And as you look at that, I just realized you guys around the corner probably can't see that, but promise me, it says spend or, save or, invest or. So as we look at why we are starting to become investors, a generation or two ago, we stopped looking at money and started to say, my company is going to set me up with a pension system. Social Security is going to pay me after my days in time are done. Those two dependency programs are no longer going to be a viable or efficient enough way for our financial freedom and your money vehicle to head in the direction you want. I love this analogy of the train versus car industry. The financial system used to be a train industry. You would spend 30, 40 years at one company building those train tracks. And then upon graduation, retirement, you got to sit in the seat and the conductor was going to take you exactly where you wanted to go. As we enter this new age of money, we have shifted from that train industry to the personal automobile. As you sit in the driver's seat, now you realize I have the greatest gift possible, autonomy. I'm not going where my company says I need to go. I'm going where I want to go. And as we start to look at how do I begin this idea of taking control and taking ownership, we have to elevate our thinking and elevate how we see money. I am a spendor. I see money on a day-to-day time frame. I get money, I spend money. You heard me earlier, my first paycheck I received, I spent. That was my relationship. That's how we all were born into, unless we had someone in our family or close to us explaining this language, we all begin as spenders. Then we get educated. Then we understand and we say, hey, I need $100, $1,000, some kind of cushion because life happens. How do I begin to introduce that kind of cushion and emergency fund? I begin to be a saver, and I begin to see my money and start to say, well, not day to day, but what about in 6 months? What about in a year? What about in 2 years? How do I begin to shift and change into that idea of thinking? But as we will see real quickly, we must move away from that saver mindset. As I look at being a spender in a checking account, I can get 0.1% interest. As a saver in a savings account, I may be able to get 4% interest. And as you look at that 4%, you start to quickly be reminded by this one word that everybody is so excited and talking about today. What word is that? Inflation. When I look at 4% coming from my checking or my savings account, is it really 4%? No, I'm just combating inflation. 3.5% goes to just that lifestyle, whether I chose to or not, increasing. As we look at the pension system going away, as we look at things like inflation today, we have to enter into this third spectrum of an investor. No longer a day-to-day thinker, no longer month-to-month or even year-to-year, but truly starting to look at money through a decade-long time horizon. That is a long time for anyone to really comprehend. But as we're learning, people are living lives 90, 100 and beyond. We have decades in front of us. And if we put our money to work for us, now we have created income for those decades. As I start to look at an investor can make 10% on an investment, I begin to really see and understand how is this idea so impactful. Has anybody heard of the rule of 72? The rule of 72. And what does the rule of 72 show us? The amount of time it will take for your money to double. If I am a student, a learner, if I am just becoming an investor, the first question I usually ask is, how long is it going to take for my money to double? That is an honest and true question. If I use that rule of 72, which is very simply 72 divided by whatever interest rate you think you can receive as your return, 72 divided by your percentage. Well, 72 divided by 0.01 is going to be like 7,000. Our money is never going to double in a checking account. We know that. I look at this savings account. How gracious and awesome is this bank or credit union to give me 4%, right? My money is going to double. 72 divided by 4 is about 18. I'm sorry. Yeah, now everybody's looking at you. 72 divided by 4 is about 18 years. But we must start to enter into this investor mindset where we start to see 72 divided by 10 as 7.2. 7 years for my $100 to become 200, for my 1,000 to be 2,000, for my 10,000 to be 20,000. We have to exceed that idea of inflation. We have to move away from the comfortability of just savings and become investors. The pre-session question was, does everybody today need to become investors? I got a lot of back and forth. A lot of you filled that out. And I'm proud to say a lot of you said no. Why I'm proud of that is why I'm on my mission. We need to accept this new age in this new world. So as you look at this, where and how, why do I need to become an investor? My company is no longer going to do it for me. They started to look at your future and your careers, and they started to see risk, liability. I don't want your future lying on me. I'm going to remove it from my balance sheet as a company onto you as the individual. That train system to the car system. Your future now sits behind your money vehicle. And as you start to walk through this and you start to see that investor mindset, now I must go accept it. And when we transition from saver to investor, what's the one thing we need to accept? What would you say is the difference between saving and investing? Risk. Risk is that jump, that leap of faith. Is it going to go down tomorrow? Possibly. But our faith in the idea that in a decade, my investment is going to go up. So why do we need to become investors? Spenders, we all see where that plan leads. Savers, valuable, important, vital first step. But we have to transition into that idea of becoming an investor. And as we look at it, the question then becomes, and I'm realizing now I'm going to have to sneak behind y'all. The question then becomes, how? How do we begin investing? Jed, how do we start to see these concepts and these ideas? And a lot of people get introduced to investing through stocks and bonds. If I said, what relationship is formed when a bond is issued? What relationship does that resemble? A loan. I give you a bond, I am giving you debt. I am letting you borrow my money, but I want my money back plus interest. I am a bond, I am a lender. When I shift and I start to look at a stock, what kind of relationship forms with a stock? Ownership. You take stock in my company, you have equity. You are a part owner. Our relationship is a partner, not a lender, a partner. And as you begin to see this, I love this quick, silly analogy around John and Charles, who are actually the owners of the RIA I used to work for. They go and start a lemonade stand. John goes and asks his mom the same thing. Charles goes and asks his mom, I need $5 to open my lemonade stand. John's mom says, wonderful. I am going to give you that $5, and I am going to give you 3 weeks where I want you to pay me $1 of interest each week. And after those 3 weeks, guess what? I want my money back. Charles' mom looks at him and says, Charles, love you. This is more of a gift. I want to take this roller coaster ride with you. Here is the $5. We're going to be partners. I don't want the money back, but if you go up, I go up with you. If you go down, I go down with you. After the first week, John and Charles both take that $5. They go start and open their lemonade stand. After week 1, unfortunately, some rain came in. Nobody was buying lemonade. They lost $1. John looks at it and says, I lost $1 from company. Charles, I lost $1 from the company. And now John also has to pay that $1 of interest. Charles looks at it and says, well, technically I didn't lose the full $1. I have a partner. My mom lost half, I lost half. We're not totally out of the system right now. Week 2 comes around and they started to have a little success. Both boys sold $2 of their lemonade stand. John looks at it and goes, that's great. Still owe my mom that $1 of interest. Charles looks at it and goes, that's great. I made $1, mom made $1. That is the relationship. After 3rd week, we start to look at it and they hit pay dirt. They both make $6. John looks at it and says, well, I have that last interest payment and I have to give the $5 back. I paid off the interest and now I need to give her $5 back. Charles, on the other hand, says, $6. Mom, we're starting to make money. I just made 3, you made 3. What happens after week 3 in John's relationship? She back to 0. She goes away. Mom got her interest. Mom got her money back. She was a lender. She doesn't want to take this journey with me. What about Charles? Is his mom sticking around? His mom is a ownership. She is a part owner of this business, and she is going to look at it and say, excellent, we've started to figure it out. How I look at bonds and stocks is exactly in that format. Am I forming a lender relationship? Am I forming a partner relationship? As I start to identify which has a higher return, which one do you think would have a higher return potential? Stocks, which means what is inherently going to come with it? Risk. If I have a higher return potential, I'm accepting a higher risk potential. That is the give and take, no different than savings and investing. Savings is protecting myself from that risk. Investing is not just adding risk, it's welcoming risk. I cannot have a higher return without a higher risk potential. So anytime a company says we're going to give you a higher return, understand they're also telling you we're going to give you a higher risk. As you see these two, they can break down into what types of bonds. Who is the loan going to? Everybody knows the federal government will take a bond. I bought into the Treasury. That is a bond relationship. T-bill, but that's technically not. But as you look at it, I can find a very secure borrower. Security means less risk, which means I am going to receive less pay. We hear this term junk bonds. Junk bonds just means the end user is less likely to pay you back. Higher risk, what do I get to charge for more junk bonds? Higher return. So as you look at the risk profile and relationship, it's how likely are you to be paid back with interest? As I look at stocks, two of the measurements are small, mid, or large. If I was going to bet on a company, feels like Microsoft is going to be here in 5 to 10 years. That is a large company. That risk is lower, so my return potential is technically lower. If I invest into a small company, which who knows is going to be here in 1 year, let alone 10 years, that risk potential is higher, my return potential is higher. As you look at stocks, you will hear two terms, growth or value. I like to use analogies. This, to me, is very similar to a football team looking at a quarterback. If I am looking at the NFL draft coming up and I want a growth stock, that's going to be my number one pick. I am getting them today in hopes that their expectations of the future go nowhere but up. I ride and exceed with that expectation. If I am looking for a value quarterback, it's that one that got hurt last year. Maybe he was worth $10 million a year, but now with the injury, I can get him at $7 million. So I look at where I am purchasing them and saying, I believe the value is where I am getting them, not where they are going. As you look at companies, startups are all growth. Technology, AI right now is growth industry. As I look at value, Procter & Gamble went down. Are we still buying toothpaste? Yep. I think I can get Procter & Gamble at a valuable price. So as you start to look at where your risk measurement goes, the size of the company and the expectation, but also in where you think you are purchasing them and buying in. So as you identify bonds versus stocks, I really want to introduce you to that risk profile. And that word is something that I continue to repeat. You hear from me. As we look at now, Jed, how do we go about this? How do you go about buying a bond or buying a stock? We can look at it through a few different lanes, one of which is perhaps one of my favorite little analogies. And I, again, don't get lost in the football terms. Anybody a football fan, who do you think is going to win next year's Super Bowl? All right, I got two Green Bay. I don't know where. Who dat? Eagles are going to repeat. Anybody but Dallas. So let's go with this thought. We have the Green Bay Packers. You are betting that one team is going to win the Super Bowl next year. We got the New Orleans Saints. Now, the New Orleans Saints are in something called the NFC South. They play the Saints, the Bucks, the Panthers, and the Falcons. For the same bet, would you accept all four of those teams from the NFC South against his Green Bay Packers? Absolutely. She gets her Saints along with three other possibilities against his one team. Somebody said the Raven, who else hollered out? What other team? The Chicago Bears. I love the focus. No Chiefs fans? Wow, strong. That's amazing. Okay, as we see it, we have four teams in the NFC South. We have one team for the Green Bay Packers. If I came to you and I said, you get 16 teams in the AFC, this is an NFC team, this is an NFC conference, you get all 16 teams in the AFC against her 4 and his 1. Would you take that bet? Every day of the week. Not a trick question. If I came to you and I said, he has 16 teams, she has 4, he has 1, you get to bet somebody from the NFL is going to win the Super Bowl next year. Would you take that bet? I had all 32. This is exactly how you can begin to become an investor. I can take on, thank you, I like it. Under the breath, he was like, that was good. He already knows where I'm going. I can take a single company, the Green Bay Packers. I can invest on one thing. Who has the highest return potential? The person with the most risk. He is going all in. She said, I like my Saints, my Who Dat Nation. I also would like a couple backup plans. I get 4 teams. That is called a mutual fund or an exchange traded fund. In today's world, very similar products. The fees have all come down. How they're taxed is a little bit differently. How they're traded is a little bit different. For the most part, it is a gathering of not 1. Now you get 4. He took 16. That's a bigger mutual fund. It's a bigger ETF. I got 4 I like, or I took 16. The concept I want you to walk away with is her choice. 32 teams in the NFL. I don't know. There's a lot of crazy games. I was actually on the elevator with an Eagles fan who goes, I love it. I was at the parade. Are they going to repeat? It's hard. It is hard to repeat. I don't know who's going to win next year. That's the beauty of the game. But I can bet on all 32 teams in the NFL. That's called an index fund. As we look at this, an index fund is not a selection of 4 or 16. It is the market. If any of you have your phones, go ahead and grab your phones real quick. Do me a favor, look up how many companies are in DOW, the Dow. You got your phone? Good guess. Can you look up how many companies are in QQQ? How many companies are in QQQ? Can you look up how many companies are in RUA? RUA. Last but not least, who else has their phone out? Can you look up how many companies are in VT? Last one, VT. How many companies are in VT? I like it. Depends on where you are in technology. Some of you went to like Google. Some of you went straight to ChatGPT. Some of you just talk into their phones. My daughters will never learn how to type. They talk everything. They don't even text. It's amazing. Okay. How many companies are in the Dow Jones? 30. The Dow Jones Industrial Average. You hear that term. Well, the Dow was up 2 points today. Now it was down a point. The Dow used to be a direct indicator of the United States economy. We used to be an industrial economy. The Dow, go look at those companies. You will see the names from the 70s, 80s, and 90s. Are we still in an industrial age? Not necessarily. Is that a direct reflection? No, but if you think these people, these companies are not going anywhere, I, with one choice, can purchase 30. Who had QQQ? How many was there? And do you know what they're gathering? Does it say what kind of companies there are? Non-financial technology companies. Well, we're not in the industrial age. I want to be young. I want to be current, new. I want to go bet that technology is going to be the future. One choice, 101 technology companies. Who had VOO? Who did you have? RUA? Yes, RUA. How many are in RUA? Companies in Russia. That's not exactly where we're going for. That's diversification. We'll get to there. RUA is a Russell index of 3,000 companies here in the United States. I don't know. Does anybody know what? How many are in the S&P 500? It's not a clever name. So VOO is the S&P 500, the 500 largest companies here in the country. RUA is, I don't want just the 500 big ones. What about the 1,000 small ones? Here's 3,000 companies in the United States. Well, Jed, this is all based in America. What if we want to go international? Did you look up VT? How many were in VT? 9,864 companies, you made one selection, one choice. You bet on the world economy. Are you going to be a millionaire overnight? No. Are you going to lose all your money overnight? No. Diversification is this cushion. As we look at it, you always want to be able to say, a single event is not going to take my plan down. If I'm betting on the Packers, they lose their quarterback, my plan goes out. Even if I have the NFC South, is there a chance all four of those teams go down? Absolutely. QQQ. Technology is a can't miss, right? Until this last 2 weeks, and all of a sudden it's like, oh, NVIDIA, maybe it's not a endless quadrillion-dollar business. Maybe there is some reality checks. How do I keep elevating and removing the singular thing? I keep adding diversification. Yes, I do believe the S&P 500 is an excellent start to your plan. But do I believe you need to graduate and elevate, and as your money grows, start to look, hey, Brazil, what are they doing? India, China, Russia. How do I own companies in there? VT allows you 9,800 with one single choice. If you're asking, Jed, what is the money vehicle investment philosophy? Because remember, I don't give answers. We don't give advice. We educate and introduce. We make suggestions, you make decisions. Our investment philosophy is be average. Be average index. Can you explain why that concept? What does be average index mean? So I am not on average 7 or 8%. I am not going to just look at the market and go, Amazon's up 74%. I get up. No, because Amazon's up 74. There's a lot of companies that are down. I average out. Good news. When these companies are up and that company is down, you average out. Investing is the only place I challenge you and I challenge students across the country. Be average. Sit back. Take what the market is giving you, 7 or 8%. Can we use that rule of 72? That means my money doubles every decade. That's not overnight. But if I am 40, 50, I still got 50 years of investments in front of me. So if I look every 10 and go, my money's going to double. My money's going to double. The other beautiful part about an index fund is it cleans and filters itself. If NVIDIA comes out of nowhere and skyrockets, cool, they go to the top of the list. Guess what happens to Company 500? Kick them out. I didn't make a trade. I didn't have to keep update. Nope. I just trusted what the average of the market is going to return to me. Why do we need to begin to invest? Because we have to go seek higher returns. How do we begin to invest? Be average index. As you look at that single mutual fund index, which has the highest risk potential? Single. But oddly enough, as we look at that average return and the reduction of a single event and the reduction of a big bad day, index funds actually outperform over time. Warren Buffett, everybody's heard of him, 2010 challenged hedge fund managers. I'm going to put $1 million in the S&P. You take $1 million and beat out their performance. He challenged any takers. Come on, $1 million bet. 10 years later, how many of them beat him? Most gave up at about 2014 when they were nowhere near competing with this average return. Financial industry pushes and presses on you. You don't speak this language. I'm smarter than you. I know. Not anymore. With your phone, with 2 seconds, you found an index fund that can give you 9,100, 3,530 with 10 seconds of information. You are powerful. You are sitting in the driver's seat. You have the autonomy. You get to choose. Now, when I look at stocks and I start to ask, well, what about bonds? Do I want to start buying into bonds? Absolutely. Bonds are going to help you control the other element, not just risk, but time. Do I know what the market's going to do tomorrow? Nope. But what if I need my money tomorrow? Well, if it's down, I got to sell at a loss. I actually just talked to a gentleman who goes, oh, I'm going to have to sell some Amazon stock and it's down now. Okay, how do I control the timing element? That's where my bond comes in. I'm going to have not only a guaranteed income stream, but I'm also going to have a date when I get that fund money back. I put $1,000 into a bond. I made 20 bucks. I made 20 bucks. I made 20 bucks. And then I get my $1,000 back. If I want to control the time, which is when we start to near our freedom years, that's when I want to introduce bonds. Less risk, better timing. If I'm young and I look at my investor horizon, 10, 20, 30, 50 years. Why I love talking to young people, your learners, 18, 25, got 75 years of investing ahead of them. Yes, ma'am. Yes. Two separate accounts. I call it one portfolio mindset. So we're about to look at different accounts you are going to have. Where do you want to see your growth? Where are you willing to accept some of the loss? But no, you are not investing over here risky and over here conservative. You're investing. Should some of it be more conservative? Do I want to start out with the S&P 500 because I think I can get my 7 or 8% B average? Absolutely. When I feel knowledgeable and empowered to take on more risk, these people don't know. My first investment as a single stock picker back in 2008, Lululemon. Why? My wife and all of her friends started buying this small company from Canada. I went and bought Lululemon. I'm a genius. It was silly. I was like, why do people work? Just pick companies you see around. My next 19 stocks, not Lululemon. So you can find success. You can take on more risk when you feel I have my foundation of my portfolio. Now I'm ready for more risk. Well, yeah, stocks are good. Now I want to go do real estate. Excellent. That's diversification. But yes, as I look at it, I will see different accounts. That's a perfect time to transition over there. Perfect. So now I'm going to start to look at different types of accounts and how I start to see these. Again, as you can tell, I'm an analogy. I like stories, why people connect to them. What Money Vehicle teaches is not inherently new. How we teach it is through these stories. I grew up, my father is a gardener. He's actually a lawyer, but every Saturday morning you'd believe he is a gardener. So we grew up doing a lot of yard work. And as I looked at it, I started to realize you can treat plants, trees, things differently. As I saw it, we went and we got 3 different trees from Home Depot. That first tree, they came to us and they said, you got to do the traditional way. You're going to take this tree home. Before you put it into the ground, trim it, prune it, make it the way you want. As it grows, and you want to have people over, you're going to prune, trim it, cut it down, and do it again. So this one, I have to do before and after. Before it goes into the ground and after it goes into the ground, I have to trim it. Then a gentleman came up to us and said, you've obviously never been introduced. This is an idea where you get to look at it and you go, take tree number 2 home. Don't trim it before. Put it directly into the ground. Let it grow. And then as you have that party, as you have people over, as you want to show it off and use it, then you have to do it after it grows. Somebody came up to us in the aisle 11 and goes, that's good. I like this idea. But how do we get to tree number 3? Tree number 3 said we have a specific soil we use. If you put it in this soil, you'll never have to trim your tree again. It's called Roth soil. They came up to us and said, when you get home, you are going to have to trim your tree. But after it goes into that ground, you never trim this tree again. That concept, that silly analogy of tree 1, 2, and 3 introduces you to the types of vehicles, the types of accounts you can go invest in. I want to be average and use an index. Great. Do you want to do it in a brokerage account? Brokerage account, excellent. Excellent resource. I'm going to take my money. It's going to be taxed. I put after-tax dollars into it. It's going to grow, 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 and I'm going to be taxed again. Does anybody know what that second tax is called? Capital gains. I will be taxed again after it grows on capital gains. Well, I don't want to do that. That's being taxed twice. How am I only taxed once? This is going to be your 401k, 403b, or anybody on their own IRA, traditional IRA. It says, I don't want to tax it before I put it into this account. They're going to give me a tax deduction. Government's not going to look at this money for now. I take that full $5,000, I put it straight into my 401k or IRA, and it grows. But when I want to use it later, I have to trim it after it's been in the ground, after it grows. This third one is that unique soil, ROTH. And if you were to ask Jed, what is the mission of Money Vehicle? It is to get 1 million students, and that students 13, 23, 33, 53, doesn't matter, open Roth accounts. Why? They get their money, just like in the brokerage, it gets taxed. They put it into this account, after-tax dollars, never taxed again. I don't make predictions. I don't make guarantees. If I were to guess, one thing I would look at, in the future, taxes are going to be higher. Yeah, it's funny. It ain't that funny. It's reality. If I want to remove that liability, I want to be taxed today, but never again. That's what the advantage of a Roth IRA, Roth 401k, Roth 403b, anything with that Roth word says, tax me today, never tax me again. This is how you start speaking the language of money. Now, in your accounts, how do I invest? This is where I am investing. How do I invest? This is when you start to be average. Okay, great. I put my first money into a 401k or a Roth account. What do I invest into? I invest into that idea of the S&P 500 or whatever you choose. As I look at these, I ask myself, and again, I walk into a lot of young adults, 18, 19, what question do they ask me? Where should I put my Bitcoin, bro? Where's my Bitcoin? I don't own a lot of it. I own an index fund of it. Shocker there, right, guys? Why do I want my Bitcoin in my Roth? Let's say it goes to the moon. I take my $1,000 of Bitcoin, it becomes $1 million. What do I not owe? Taxes. If you are asking yourself, where do I want my highest risk, highest growth, biggest gains potential? That is going to be in your Roth account. Why? Because I don't pay taxes on the growth. I'm taxed before it goes in. Why is this better, even more so for younger people? Is because they're in their lower tax brackets. We talked about that yesterday. What tax bracket am I in? If I'm in a high 30% tax bracket, give me the tax deduction. That's great. When I talk to NFL players next week, your 401k, take it. You just saved 37%. That's incredible. I'm not in the 32% tax bracket. I'm in a 22. Let's talk about that Roth. Let's talk about never taxing these dollars again. Questions on these three elements right here? Yes. 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 So W-2 would be 401k or 403b. I work for someone. I cannot put in to a Roth if I'm showing a company, if I'm a 1099, if I'm losing, I can't be investing. If I'm losing, they're going to go, that $5,000 of profit you put over here, we're going to tax you on that. IRA, Roth IRA, that's an individual. So it's not at my business. It's not, this is on my own. And can I have a 401k and an IRA? Absolutely. Can you put into a 401k and a Roth? Yes. The government just wants to make sure they're going to get paid and taxed. But as you look at it, I have an income from a W-2. I can put into a 401k. and my company has a Roth, even better. If I look at my 1099 income and I am reducing in the expenses, I cannot then say one of my expenses was investing into my future. That's profit. You have to show and get taxed on that profit. So those are different. Yes, ma'am. Yes, there is. Great question. So 401k feature this year is going to go up to, I believe, about $23,000. A Roth is only about $7,000. Now, are there ways around that? Absolutely. And are there income limits? Sure. But this is why you speak the language. Backdoor Roth IRA gets rid of the income limit. The amount, there are other backdoor IRA Roth conversions that people call them super backdoor Roth IRA conversion, and I can plug more money into this. But if you were to look at the traditional, I just want to take some of my after-tax check, put it into an account, be average, and become an investor, that limit's going to be about $7,000 this year. That's still an amazing place to start. And as you look over $7,000 each year, that is going to grow and grow very quickly. Great questions. Any more questions on this idea? Excellent. Yes. Absolutely. So they're going to tell you got to tax it. So as you roll it, and if you leave a company and you say, hey, I want to take my 401k with me and turn it into a Roth, you just get taxed on it. It becomes income that year, taxed, and then as you transition it, it goes into that Roth account. So obviously, if you leave old 401ks, currently there is almost $1 trillion of old money sitting in a 401k, nobody rolled over. If you've left a company, go back, make sure your TPA, third-party administrator, should help you transition that over. But as I transition it, I say, cool, at my new company, I'm going to do the traditional 401k route. I want to take this $10,000 I had, get taxed on it, and open a Roth account. That is absolutely acceptable and a great idea. Because now you're not only diversifying how you're investing, you're diversifying where you're investing. When I am 75 and I want to pull money to support my lifestyle, I can pull from my Roth. No taxes, easy. Or I can pull some from my 401k, be in a lower tax bracket on those, and the moment it goes to that higher tax bracket, I go, stop, pull from the Roth now. So I can pull $25,000, $50,000 here, I can pull $25,000, $50,000 there, and reduce my tax liability. Speaking the language, playing the game. That is our last and kind of cumulative action item for students as they go through Money Vehicle. Why I begin with this concept. 10, 12 years ago, I walked into rooms, I said, I'm going to teach you about Roth IRAs. People go, we're not even investors yet. I don't know what I would choose if I did open a Roth IRA. I haven't set goals. I don't know taxes. I don't know my insurance. We had to back up and build the entire curriculum, but that is the driving action. You take that action and you tell me, Jed, I just put $7,000 into my Roth. You told me I speak the language, I'm thinking longer term, and I'm acting wealthy. I'm acting like an investor. Questions there? And then I got one more subject before we move on. Awesome. So then people started, and again, this isn't so much for the students, but for you in the room, people said, well, how do I find somebody to help me? Jed, are you going to invest my money? No. Thank you. I gave that up. I stopped that. Why I get to talk to 1,000 professional athletes a year is because I stand in front of them. I go, I want nothing from you. You all, I want a little something from you. I want you to check out your Money Vehicle, obviously. But as far as this guidance, this is just education. I'm not giving you advice. I make suggestions. You make decisions. But if I were to go talk to somebody about my money, there is a term, there is a word. And as I look at it again, a story pops into my head. I walk into a restaurant, I sit down, the server comes up to me, and this is the expert. They are the ones looking through the menu, telling you what you should and should not buy. They should understand. No difference than sitting down and talking to somebody about your money. That server walks up and you say, there's a salad, a fish, a steak. Which one should I choose? They look at the menu and they go, choose the fish. What they didn't tell you was the chef caught them before the rounds and said, the fish is starting to turn. We got to get rid of the fish. I'll give you, the server, $1 for every plate of fish you sell. That in the financial world is called the suitability standard. It was on the menu. It was suitable for you to choose. I don't have to tell you anything else. I suitably recommended the fish. Now, as I enter into that same restaurant, different server walks up to me under a different standard. Does anybody know what the different standard is called? Bam, he cheated. It's on the board over there. I wrote it over there. It's a funny word, fiduciary. Funny word. What does that mean? Well, as a fiduciary advisor, when I walk up to you, I look at the salad, the fish, and the steak, and I say, hey, the fish is starting to go sour. Let's stay away from the fish. As I walked up, you said you had a burger for lunch. Following up a burger with steak, that might be a lot. Let's go with the salad. I believe it is in your best interest to choose the salad. That is the key. Suitability, it was on the menu. Fiduciary, your best interest. As a fiduciary advisor, I have a legal liability to put your best interest first. That is where I start to talk to people about their money. Jed, these investment people make a ton of money. Well, are they making a ton of money for you and for them? Have you asked them that? If you're going to sit down and talk to somebody about your money, the 3 questions are, why are you not my fiduciary? I'm not telling you anybody who's not a fiduciary to tell them no, but I am telling you they should explain to you, if you choose this index fund, I make a little bit of money. If you choose this, I'm also going to sell you some insurance along with it. Guess what? I sell the insurance. As you look at it, why are you or are you not my fiduciary? The second question, how do you get paid? A fiduciary cannot get paid on on products. They cannot recommend this index fund and then get a taste. A fiduciary gets paid a flat fee. You look at them and say, I pay you this. All advice, guidance, recommendations, you do not get an extra taste of. You get paid this and nothing else. How do you get paid? Are you going to charge me on my whole balance sheet? I just put $5,000 into a savings account. Are you going to charge me on that $5,000? Hey, I got equity in my home. Yes, it shows up on my net worth as money, but it's my home. Are you going to charge me on my equity in my home? Some do. How are you going to charge me? Is it full balance sheet? How are you deciding that? And the last one is going to be what services. Coincidentally, literally, and I love this. I don't know if any of you were there this morning, but I got a note handed to me, and I just look at it and I go, gosh, I love what I get to do. Last night, NFL player called me. Haven't talked to him in probably 2-3 years. I talked to him as a rookie and as a second year. He's now in his second contract. Makes more money than I'd like to believe or think about. Like, you're fine. But he starts talking to me about these advisors that he got 4 years ago. I helped him walk through, ask the questions. Jed, they have done great. At the time, all I wanted was somebody to take my money and create more money. And guess what? We've averaged 13% the last 4 years. Man, what's your question? This is, I feel like there's more that I should be doing. Well, you have a question now. You hired them to be your investment advisor. Do you want a holistic advisor? Do you want somebody to talk to you about taxes, insurance, estate planning, your bank accounts, the house you're about to buy, the car you bought? That is not an investment advisor. So that last question is, what services do you provide? Am I going to give you $1,000 and be happy when you turn it into $2,000? Or am I going to ask you, why didn't we look at different accounts? What about the estate plan? I'm thinking about being charitable. Where is all these tax things? Do I want other services? If you hire the hired gun that says, go do investments, don't be disappointed when they don't change their stripes. His advisor currently looks at him and goes, 13%, man, what's your complaint? My complaint is I still don't have a trust or a will set up. Well, that's a problem. So who are you hiring? What do they provide? How, why, and what are your 3 questions for a fiduciary or any advisor that you're going to talk to about your money? Questions? Perfect. Absolutely. So if I were to sit down, and I used to do this, I would sit down, I would say, who are you trying to impact? Who are you trying to help? That's where this plan starts. We begin with the end in mind. What desired lifestyle do you see when you hit that term called freedom? Is that a $5,000 a month? Is that a $25,000 a month? Let's play through that. Now we can build a plan to arrive there. I have 2 kids. I have a charity. I have a cause. My sister's special needs. I love Special Olympics. I support Special Olympics. I got to be with a guy who's in New Orleans, who dat, for the Saints, named Steve Gleason. Man is amazing. He's had ALS for way longer than he was supposed to live, and he's changing the world with his eyes. Why? Because he can't move anything else. I want to fund. How does my plan support Team Gleason? So begin with what you want your plan to do. The vehicles, pun intended, the vehicles are this trust now is meant to benefit this individual, this charity, this cause. This will now is supposed to go outside of probate and be able to direct what I want with my money, not the government. As I look at where else an advisor can help, investments is a game, but if I'm average and I can get 9, 10% without the risk and without the extra fees, what other services do you provide? And yes, they should ask about healthcare directives, power of attorneys, setting up. Those are the estate fundamentals and basics. Maybe you're not there. That's fine. They should start entering into taxes. How do we save money on taxes? I'm a proud American. We need to pay into our society. I don't want to pay $1 more than I owe and $1 more than I can get to. That's the game. Speaking the language. 20 years ago, this was a foreign hidden secret. Today, groups like Jumpstart, groups like credit unions, groups like Money Vehicle, we're trying to educate and translate this foreign language. It is not hard. It's just a foreign language. Understanding is the first step. Discipline and following it is the hurdle that most struggle with. This is not an overnight thing. Why am I not an overnight TikTok success? Because I don't look at a 17-year-old and tell them they're going to be a millionaire by next week. I don't sell them snake oil. I sell them, let's start with your mind. Then we'll go to an action, and then we'll go to some efficiencies along the way. It is building the program. It is teaching the language. Questions? Okay. If you have filled this out, I don't know if anybody, let me grab these real quick, sorry. Fill these out. Anybody else needs scan or sign up? Thank you. Awesome. There's another sign up over here. Perfect. Here you go. So my action, my request of you, 1, welcome the continued conversation. You can QR code that and we can meet. If you are curious about Money Vehicle, I'm going to take 2 minutes and do my spiel because as we were talking about, I love this. I have spent more time over the last 10 years than you can imagine building this. I hate selling this. It's crazy. It's funny. Put me on stage, give me a microphone. I could do this all day long. The sales part, I hesitate. This is where I want to call your attention. Semester-long teacher guide. I talk to so many people who are being handed money. Go teach these people about money. What? Every day, every conversation, every subject, every technique, everything I get to do, everything I've done over the last 10 years, you get handed word for word in your room. Yes, we have everything. We have textbooks. Who wants a textbook? Anybody want a textbook? Perfect. Love it. Good news, this has a printing error, which is why I get to give it away for free. That's called lemons to lemonade, people. It's all the information. It's just some of the pages got out of order. Anyway, yes, we have textbooks. We have workbooks. We have videos for people who don't like to read. Hello, most people today. All of that can be delivered virtually. That capstone character project, your students will, and you might be your first student. Your students go through that first mile of money, the first 12 actions. How do I build a financial plan? Each chapter has that singular action that you end the program and you go, here is how I would go choose my bank or credit union. Here's how I would get my credit card. Here's how I would choose an index. Here's how I would open my Roth. You tell us in that character, changing from education to application. But that semester-long teacher guide, I cannot emphasize that more. I meet so many people who say, Jed, I would love to. We love the videos, but I don't know how to stand in front of people and talk about it. Here's your book. It's printable. It's online. You take it how you would like it. It is here and now. People tell me all the time, there's no way you built a curriculum. 2015, I actually went to the Jumpstart Standards, started building this program, and now meet and exceed every national state standard in the country. We have 20,000 high school students currently in the program, 5,000 college, and 1,000 professional athletes. I am more than overwhelmed and proud. It has not been fun. It has not been easy. But I get to meet people like you, and if you want to continue this conversation, QR code that thing. I'm going to grab the sign-up sheets. Let me help you teach the language of money, because I truly believe if we speak money, we're going to act wealthy, and we're going to change the future 1 inch, 1 person at a time. Thank you so much for your time. Seattle, but to tell you the truth, we go everywhere. So I'm not far from you. Oh, thank you for your time. It is.